Hi, good evening, guys. Yep, so for those who have just joined early, thank you so much. So those who have come in earlier, do help me just answer this poll, which is safer, stock market and savings account. Thank you, and we will start in 5 minutes time. So I think the time now is 7:55. We are 5 more minutes to live. So how guys, what's up? I think there is a new wave of COVID, I feel, but I think there is also a flu bug that is going on, that is spreading everywhere. And I feel that I'm also one of the victims. I don't know, because I also feel a bit itchy in my throat. So if you do hear me cough a little bit, I'm so sorry, but I'll try my best to control lah. Yeah. Hey, by the way, guys, have you all today is the first day of the what? The burger laksa burger thing, right? Or the chicken laksa burger, whatever, and the prawn. Anyone tried already? I thought it was okay lah, honest opinion, okay lor. But if you guys want to try, feel free to go ahead. At least for my personal view, I won't go for the second one. Yeah, so I think I'll just stick to my McSpicy, even though I don't really eat McSpicy. Actually, I don't really eat fast food all the time. Yeah, because I need to control my diet. Recently, I have not been exercising, but yeah. So, well, okay, we are 3 more minutes. I think the last time I did a webinar was quite a while back. Actually, I also cannot remember. But I think I want to maybe do a continuous one. Hopefully the next one will come up soon lah. But I haven't thought of a new topic yet. So let's see how it goes. And thank you guys for supporting. Hey, by the way, guys, if you have friends that nothing to do, can just send them the link also. So I'm not sure whether we still can sign up or not, because I think we still have 2 minutes left. But if you still want to push the registration link to your friends to get them to sign up now, feel free to do so. Or if you want to watch this with your family, feel fine too. Yeah, so another 2 minutes. So try. If can, then yeah. But I think after 8, if they want to come in, then maybe you can try sharing your own link to them. Should be able to work lah. But that means to say, 2 of the same names will appear. One more minute. I think less than 1 minute. Most of you have joined already. I see quite a number of you inside the webinar. So counting down, and then we will start at 8 p.m. sharp. Okay, friends, it's 8 p.m. So let us start this webinar proper. So I think before I even begin this webinar in a proper fashion, I want to maybe put out a disclaimer here first, because today's presentation is really not to recommend any products or purchase. If, let's say, for example, after this webinar, you have some ideas in mind, you are interested to do something, please go back to an advisor who have invited you to this webinar. So thank you guys for joining. So let me start the webinar proper. Okay, let me just end the poll right now and let us take a look at the results. All right, so interestingly, right, we do have people choosing the option of stock market. So just to let it a little bit, actually this question is not meant to be a trick question. But then maybe some of you guys who have actually chosen stock market, you might have some perspective otherwise on what is safe and what is unsafe. So I do have my own perspective as well. So I will also share later on, but let us just start this. All right, so moving on. Let me take a look at what's going on. All right. Okay, so a little bit of what is happening in the market right now. This is what the interest rate of all the various savings accounts are giving to their clients. So for example, if I were to put my money into DBS multiplier, then maybe realistically, I can get an interest rate of about 0.5% now. So yeah, so if let's say, for example, you want your money to be safe and sound, don't want anything to happen, this is the interest rate that you are going to earn. So in contrast to someone who decides to say that, okay, I am not going to put any money into my bank account because the interest is not exciting at all. So this is what is happening right now. So unfortunately, we are already in the bear market, and that was what was the announcement 2 months ago by the US side. So we just have to go through this thing. Anyway, this thing is very common. Every 2 or 3 years, the market will always correct itself. And then every 10 years, as they say, the market will correct big time. So I think this is one of the periods where it's very tough for a lot of people. Yeah. So allow me to introduce myself a little bit. So Shawn here, in case some of you don't know who I am, I'm the Senior Relationship of Synergy Financial Advisor, and I'm doing this on behalf of my team, Advantage. So this is a picture of us, and this was taken around 3 months back, awards night. So if you might be able to spot your advisor over here. So we had a good time. So thank you so much for joining this webinar. And let me just move on to what are the main things that I want to share with you all today. So today's objective is very simple, 3 main objectives. The first objective is that I want to maybe share a little bit of what are the misconceptions out there of what people think about the bear market, right? So this is number 1. And then number 2, how did all these misconceptions come about? Because they don't just appear out of thin air, right? And then lastly, once we know how the bear happens and why do we have all these misconceptions, I will want to equip some of you guys or every one of you here, what are the things that we can do to take on the bear. So let us start proper. But I think before we go into all these objectives, I want to do a little bit of guesswork over here, just to gauge what is the kind of audience that I have today here, right? So maybe one of the audiences that you belong to is someone who have already lost money from investing. Maybe you have started early this year or started late last year or whatever. So you are not alone. I'm also one of them. So this is my account from Mumu. If some of you are also invested in Mumu, so this is my account. Year to date, actually just last month, I haven't went in to see, but I think it's still somewhere similar, but maybe already recover a little bit because yesterday, if some of you was up about 2 a.m. in the morning, Jerome Powell said that they are going to increase the interest rate by about 75 basis points. So it was within expectation, and then the market just went up. But it will be interesting to see what's going to happen to the market in another maybe 1.5 hours. Yeah. So, and then this is also another portfolio of mine. So yeah, I'm also in negative returns. So I'm also waiting for the market to recover. Nothing we can do. And then maybe some of you are people who are scared to invest. And maybe it is because you guys have saw this kind of news appearing everywhere, right? Wow, it's always very negative. And then you see the captions and then the headlines is always trying to feed you with all the scary stories about the bear market, right? And then after that, because you are fed with all these scary stories about the bear market, you decide not to invest. And just to share a little bit, share some fun fact about this business news channel in US CNBC, they have this special report called Markets in Turmoil. So how it works, right? Very funny. When the market drops by a certain percentage, I don't know how many percent lah, but when the market drops by a certain percentage, CNBC already stand by this special report, and then they will start talking about, wow, the markets are in turmoil lah, or this drop lah, that drop, everything also drop. So if you have time, just to kill time, you can go back to the episodes over here. Let me just go back to the episodes over here, and then you will see that, hey, how come every time they report this kind of news, it's always like about the same one? It's very templated one. Yeah, just go and take a look. It's quite interesting. And yeah, so when you see all this news, you will naturally be scared, right? And nothing can be done. It's just, may I say, kind of a negative reinforcement. So this is the second group audience. Maybe I guess that you are part of them. And then lastly, this group of people, very common also, right? Everyone also want to be safe. Nobody wants to take risks. It's very normal. So everything also put inside the bank account. Nothing wrong, nothing wrong. It's just that maybe at this point in time, if you remember the question that I posted earlier, which is safer, stock market or bank account? And most of you said that it's bank account. And let us take a look at this news, which was posted in Jan 30th, 2022. And then maybe you will realize that, okay, the traditional role of the bank as the custodian of our money might have already start to toe the line of being a bit unsafe already because of all these scam news. Then, yeah, so if you guys remember, it's July now, so 6 months back, this was quite a big hoo-ha. And then I think OCBC got questioned by our authorities, see how they are going to fix this mess. So when you see this kind of news appearing everywhere, right? Like this poor man over here lost 500,000 in a span of 2 hours due to a phishing scam. And sometimes it's not their fault. Maybe just a slip of a hand, they saw an SMS, they go and press, and then that's it. Their entire life savings is gone. Then another example over here, like this lady in 2 minutes, I think in a few minutes, the article say, wow, lose $100,000. So when you contrast this kind of risk to market risk, then you might feel that, actually, the stock market is not that risky after all. Because if you compare to the left side, over here, it's an instant loss of 500,000. That means you don't ever recover your money back. Unless the bank is willing to, on goodwill, give you back the money. But then over here, yes, you have lost 17% over here. But you know that if you have done your due diligence, you know that the whatever stock that you have invested is sound, then there is a possibility that this negative 17 will become positive something. So, of course, me trying to put this comparison out here, I'm not trying to tell you guys to stop trusting the bank entirely. Definitely not. Because as the bank themselves, I don't think they also want to cause trouble for their customers, right? It's not in their interest to do so. So you see now OCBC, there is some reputation risk that they need to handle. There's a lot of PR damage that they need to fix. So of course not. The bank won't want to do that because it's too much cost to them. So sometimes we need to understand the problem lies with the perpetrators. It is not really the bank's fault that they want all these kind of things to happen. So if, let's say, for example, some of you may be a bit extreme, don't want to trust the bank anymore. No problem. Instead of putting your entire 500,000 into one bank, and then if you don't mind the inconvenience, then just spread the 500,000 to more banks. Maybe 100,000 in OCBC, another 100,000 in DBS, UOB, so on and so forth. And then if, let's say, for example, a scammer wants to target DBS, you know that you just lost that $100,000, but the other $400,000 is still intact, right? So this is one way you can diversify your risk, right? So I want to, before I move on to the big main points of this webinar, let me just put out some disclaimer out there. So for some of you, if you are here to see whether I'm able to recoup your loss, I'm sorry, I can't do so because I am not God. All right. And then the second point is, if you are here to see whether I can give you some tips on super high returns with the least risk possible, I'm sorry, this is not for you as well. This is not a get rich quick scheme. I am not here to advocate this. And then lastly, if you are here because you believe in a get wealthy slowly scheme, this is for you. So stay on. So dollar cost averaging. Don't worry, guys. I am not going to show you the technical mechanics behind dollar cost averaging because I believe most of you here are familiar with dollar cost averaging. So I'm not going to go into that. And therefore, I want to show a little poll about dollar cost averaging, and I hope some of you can participate lah. So let me just take out the polls a little bit. All right, so this is the first question. Just 20 seconds. Okay, just another 10 seconds more. 5, 4, 3, 2, 1. All right, so I'm going to end poll over here. So let me just share the results. Interestingly, we have quite a number of no's as well. So maybe your confidence have wavered a bit, I don't know. But good, I do see that some of you are still continuing your dollar cost averaging journey, right? So good for you. So let me just stop share. I have another question. Hold on, let me just put it up. And here, this is the second question about dollar cost averaging. So when did you start your dollar cost averaging? So another 20 seconds. Interesting, interesting. I can see the numbers live going on. Okay, another 5 seconds. 5, 4, 3, 2, 1. Okay, so let me end the poll and let me share the results with you. So we have a very diversified mix of results over here. Very interesting. So there is also that person who have invested, who have dollar cost average 15 years ago. So thank you for trusting the process. So really just continue what you believe in. And for those, may I guess that if you have started dollar cost averaging 2 years ago, maybe some confidence waiver already, but hopefully this webinar is able to give you some new perspective lah. But okay, so let me just stop share. And I want to ask a very simple question about dollar cost averaging, which is this. For those who continue to dollar cost averaging into whatever you are doing right now, the question is why? Why? There's no poll over here. It's really just a rhetoric question. And for you to ponder while I am running this webinar for you, and to later on, I'll also be giving my perspective of why we should continue this year, but that's for later. So we start the webinar proper now. The first misconception about the bear market is that I think a lot of people out there, if you have friends saying, if you have friends, you go out with friends for dinner or whoever, maybe people who have never invested before, and then they see the bear market and then they will say, oh, I confirm lose money one. Why should I put money inside the bear market? Very common, right? You hear already also sian, right? When you are an investor, sometimes because of these people who maybe have not invested a single dollar into the stock market or whatever investment, and then they keep harping on the prospect that bear market is a confirm lose money proposition, then you yourself as an investor, you don't like it as well. So let us wind back to May 2021, where the narrative was a little bit different from recently. So cryptocurrency and NFTs. So anyway, ladies and gentlemen, I know that some of you are invested in cryptocurrency and NFT. So and I know they have their merits. It's just that maybe from a layman point of view, I just want to illustrate the point whereby if you don't understand certain things, just please don't go in. So 1 year ago, we see this kind of headlines appearing, right? Cryptocurrencies, NFT. Wow, this 25-year-old say he's a millionaire after investing early in this Ether and Bitcoin, and that was in May 2021. So exactly 1 year and 2 months ago. And then we fast forward to 1 year later, we see this kind of news appearing. A very big change in the narrative, like what hard lessons from crypto crash, and how a trash talking crypto founder caused a 40 billion crash or whatever. So the narrative has changed very drastically. And it seems like this kind of headlines, right, is always a bit hindsight 2020, right? So this is what is happening in the cryptocurrency space right now. So, but then I know that recently, one of the two stable coins, I think Ethereum or Bitcoin, has recovered has went up quite a bit. So I think I'm not sure what's going on right now, but I feel that at least for now, the sentiments are still very bearish about cryptocurrencies. But not saying that you should not do anything about your cryptocurrency. Really, if you know what you're doing, you have done your due diligence, just go ahead, right? So if unfortunately, maybe I just take out a graph to show you a little bit of what has happened. The infamous Luna coin, right? Which was this thing. If you have invested last year in May 2021, and then for some very extreme good luck, you have exited in April 2022. This is the return that you can get, about 2,000%. Not that bad, not that bad. But then, for those who have entered in mid-April 2022, I'm sorry to say, this is the extreme decline. So every single dollar you have put in, I think almost zero already. So for those of you over here who have actually put in your life savings for this Luna coin, and everything has declined very drastically, and you don't feel good about it, I suggest you quickly go and seek help, because I know that it really does not feel good. So this is the story that I want to share about cryptocurrencies and NFT. And then now I want to change this story a little bit from cryptocurrencies. Now we talk about something that is a bit more common. Everyone know one. All right. So, okay, I see some Q&A coming in. I will answer that towards the end of the segment. All right. So for Singapore, we have this thing called property. Right. Okay. Anyway, I want to do a disclaimer first. When I talk about property in this webinar, I'm only talking about local properties, Singapore. I am not familiar with overseas property, and I will not be touching them because really I don't know what is going on overseas, but I am definitely a bit more familiar with local properties. So let us take a look at the property index of HDB in Singapore. We cast aside the rules first, what MOP doesn't matter. So if we take a look at what is happening in May 2021, the property index was about 148, right? And then in May 2022, the property index value was 165, thereabouts. So if we do a very simple calculation, we can see that the annualized return is about 11%. So not that bad as compared to someone who has also invested in cryptocurrency. Your return for property is lower, definitely, but then at least you do see some return, right? So this is the contrast that we see nowadays. Sometimes you think to yourself, is it really a confirmed lose money proposition in a bear market? Sometimes it's not. So over here, I also want to redefine investment a little bit, because I think when a lot of people, when they approach investment, they always see things from this point of view, whereby they are hoping that the $1 will become $3 someday. And there's nothing wrong to think that way for investment, because who doesn't want to, right? Everyone wants to do capital gain, but so this is only just one side of the coin of investment. For me, yes, I do appreciate that there is some capital appreciation in my portfolio, but for me, I really focus more on this thing called real output, because that is something that I can see, I can touch, and I can immediately put to use. So what do I mean by real output? Let me just give you one or two examples so you understand a little bit better. So this is one of them. If let's say, for example, me, myself, I buy a house and then I rent this property out for rental income. That rental income is my real output. I can see, I can touch, I can use it however I want to. So I am not relying on my house to appreciate, because sometimes I don't know when you appreciate. I know for sure Singapore, because of the way we are designed, the way the system is designed, most houses will appreciate if you choose the right property lah. But over here, I appreciate the rental income more because that is what I can see, I can feel, I can touch. So this is one of the examples I want to share. The second example I want to share is this thing called dividend funds. So some of you might know what is it, some of you might not know. So if you want to find out a bit more, go back to the advisor that have invited you to this webinar. So dividend funds give you this real output called dividend income. So let me just, this is one of the examples that I'm going to show you. One of the dividend equity funds over here, it provides a monthly income. And as of this month, 15 July, this dividend fund has paid out 0.0059 per unit. So if we were to do a very simple calculation, this is the dividend yield of the fund. So about 5.05%. Not that bad lah. So if you are someone who are very lazy, don't like to go through the hassle of buying property to get this yield, this is one very lazy man way of getting income without going through all the other hassles. So this is a second example of real output. And moving on, this is okay, guys, I'll be staying at this point for a short while because I think that is one of the more important one. So moving on, I want to talk a little bit about this thing called portfolio value. So portfolio value, I don't know if you guys know what is portfolio value. In fact, portfolio value, right, is just made up of two variables and is merely just units and price. So I emphasize again, your portfolio value is made up of two factors or two variables, units and price. And more often than not, for some reason, a lot of you like to focus on this part of your portfolio value. And what happened? Do you realize that this price is not determined by you, it's not determined by your friend, neither is it determined by your advisors, unfortunately. But then for some funny reason, a lot of people like to focus on things that they cannot control, which I feel that is a bit weird lah. So here is my proposition. Why not focus on something that you can control instead? Do you know that you can somehow control your units to make sure that your portfolio value can grow? So let's say, for example, even if your price remains stagnant and your units, you can grow it somehow, your portfolio value will still go up. But do you really need to rely on price to increase your portfolio value? So at this case, at this juncture, if some of you still do not understand how it works, don't worry, I will have an example next. So just want to emphasize a little bit, units is something you can control in your portfolio value. And price is something, even with the best crystal ball that you can buy from your feng shui master downtown, you still cannot control it. Let me give you an example. So if let's say, for example, today we are going to focus on units, and we have done a lot of research, and then we realize that, okay, I want to do this investment. And then after doing some research, we realized that, okay, the current price per unit is about $1,000. So this is my entry price. And then after that, I decided, okay, I will go for $1,000 units. I'm going to buy $1,000 units. So if I were to do that, my portfolio value is how much? It's $1 million, right? Because price times units, or units times price. So 1,000 times 1,000, we have $1 million. The next thing, I'm going to assume that, hang on, let me just take out my, I'm going to assume that my each unit that I buy is going to pay me $50,000. So I'm going to also reinvest everything over here because I don't really need the money, right? So let me give you two scenarios as to what will happen to my portfolio value in the future. We take a look at the bull market first because that is what everyone likes, So the first thing, in year one, you have 1,000 units because you buy 1,000 units in year one, And good news, the price went up by 20%. So now your portfolio value is 1.2 million. Okay, understand? So now, same thing, because you have 1,000 units in your portfolio, you have $50,000 of income for year one because 50 times 1,000, correct? And now you are going to reinvest everything. So this $50,000, you are going to buy each unit at 1,002, and therefore you have bought yourself 41.67 units. And good news, in year two, the price go up again to 1,004, and therefore you have this portfolio value of about 1.46 million at the end of year two. And then after that, because you have more units, your income is now $52,000. So this is the bull market. So let us take a look at the bear market. Not everyone wants to see this, but I just want to show you what's going on. In year one, unfortunately, instead of going up, the price went down drastically to 600. So your portfolio value is 600,000. And then your income is still 50,000. Nothing has changed because your units is not affected by the price, so your income is still 50,000. Now, in year two, because the price is so depressed, you can buy more units with the same amount of income. Do you see that? All right, so now in year two, the price has gone up to $800, and therefore your portfolio value, there is some relief rally. So your portfolio value, good news, it has recovered a little bit. So maybe we just wait a little bit more. Then our portfolio value will go back to $1 million or even more. But now here is the magic. Because we have more units over here, do you realize that you have more income also? Instead of $52,000, now you have $54,000. And why is that so? It's because over here you have more units. So now, just going back to the point where a lot of people say confirm lose money, if you see things from different perspective, right, actually you realize that you are not losing money after all. In fact, in another dimension, which I like to emphasize again, units, you are earning what? This thing will take care of itself in the long term. Focus on this thing that is a bit more practical. So this is what I view investing from my own lens. So let us move on to the next misconception. I'm done with this point. So hopefully you guys understand. The next misconception is that a lot of people will say, wow, I should hold cash. I should hold cash. I don't want to invest because every single dollar that I put into the market, I don't know if it will be like Luna like that. So at this point, I think most of you also will understand that if we are facing this kind of very large inflation environment, even holding cash is not doing good to you. As of 2 days ago or 3 days ago, this was the news. Singapore inflation has hit a 13-year high of 4.4%. When was the last time we had 4.4%? That was 13 years ago. In between, if you guys have time, just go and take a look at the website. I don't know which government website. Sometimes inflation can be in the negative region but 4.4% is really very high. So in this environment, if you were to hold cash, definitely you are also eroding your purchasing power. And then at the other end of the globe, our US friends are also not doing that well because 9.1% as of last month. And next month, I'm not sure whether the trajectory will be the same. But now we know that it's increasing at an increasing rate, the inflation. So here is the question. Is inflation a real cause of concern or not? And over here, I don't have a real answer for this thing, but I just want to share a little bit of what I understand about inflation. And by the way, I am not an economist, so I cannot go deep and I don't have all the time to talk about inflation. But I know that inflation is always caused by these two things, mainly. So it's either demand or supply. So what is happening right now is that for inflation, we are dealing with this thing called pent-up demand. On the demand side of things, we have this thing like what tourism surge. As you can see, if you walk out of your house right now and you go to those tourism areas, you do see a lot of tourists. And then we have this thing called revenge spending, quite a popular term. I think after getting locked down for so long, a lot of people want to really just spend whatever they have saved during the lockdown, right? So this revenge spending is going on, increase in demand. And then also on the other hand of the inflation arm, right, we have this supply chain and oil issue. So just a little walk back 80 years ago, quick sharing, all these periods are all high inflationary periods, high inflation environment. And if you go down the list, right, you'll realize that it's almost always either caused by supply chain issue or oil issue. Okay, so now we have both issues. Why? Because Russian-Ukraine conflict is still ongoing. And then I think yesterday I saw the news, Russia is going to cut their gas supply again to Europe. And then after that, China, I think they are still in the midst of another lockdown, no signs of letting up. And therefore, we have both supply chain issues, we have oil issue, and we have demand issue. And the resultant is inflation very high, right? So what does it mean to me after looking at all these numbers, right? The first thing is, let's say, for example, you are a prospective buyer. It's definitely going to affect you. Let us take a look at some numbers, the price index. And a little walk back about 16 years ago, the price index for HDB was about 70.5. And fast forward 16 years later, April 2022, the price index is 164. So that's almost 2.5 folds increase in 16 years. And if we do a very simple calculation, the year-on-year movement is 5.31%. So if you are a prospective property buyer and you are not making sure that your purchasing power is increasing by 5.31% per year, you are in trouble. Okay, so the next thing is, maybe you might ask, hey Shawn, but I am not a prospective buyer. So what happened? Is it going to affect me? And I think the answer is yes, because our dear DPM Wong is saying that the GST hike is going to go ahead. We are going to be affected. Even if you're not going to be affected by inflation, this thing will still affect you. And also, fuel prices, the increased fuel price is here to stay. So this is something you have to take note of also. And then maybe you will say that, okay, Shawn, I am not going to buy property now. I'm also not going to buy property in the future. I'm just going to rent. Can or not? Will I be affected? And I feel that the short answer is yes, because you see, let me just pull out the rental price index and show you what's going on also. So in Jan 2006, the rental price index is 58.9. And then after that, 16 years later, 145.9. So the increase is almost threefolds. So, but then the year-on-year movement, we do a simple calculation, is about 5.71%. And what does that mean to you as someone who want to rent forever? For example, you are going to do a monthly, you rented a property, you rented a space. The monthly rental is $1,500 a month. The estimated rental 16 years later, based on this per annum movement, is going to be $3,600. Almost 1 month of some of the graduates income, those who just come out of university, 3.6K. So if 16 years later you don't keep up with this 5.71%, you will have difficulty finding a place to rent in the future. So this is going to affect you as well. All right. So the last misconception I want to share about the bear market is that a lot of people might be shouting, hey, you should cut loss now. If you're going to continue, then it's going to be downhill forever. And then, there's a Chinese saying, right? 没有最低，只有更低. Yeah, so these kind of things, when you hear already, you also, cannot, I should cut loss. But you know that it shouldn't be the case. And sometimes you have to understand who are the one who is telling you this kind of advice. So let's say, for example, this cut loss now, this advice is coming from a trader, you know that you shouldn't listen to them. Because for a trader, it's in their nature to cut loss. They have to. But for us long-term investors, we shouldn't do that. Why should we? Because we already know from day one that we are investing for the long term one. So there is absolutely no need for you to cut loss. It's just paper loss, right? Okay, so I am done with the misconception part. I'm going to move on to the next objective, is that why do we have all these misconception? And is it normal to have misconception or not? And the answer is yes, because we are all humans, right? We definitely will have some emotional attachment to our investments. When we see the price go down, of course, we will feel very affected. And that's very normal. And I don't want to invalidate any of the feelings over here. So why do we have this misconception? I think it's also really going back to the news. Remember them? I just shown this slide earlier. So I feel that when a person is always constantly fed with a lot of negative things, it creates a negative reinforcement cycle in their mind. And what happened? After a lot of reinforcement, negative reinforcement, the conclusion is that you will have all the misconception that I've explained earlier. So it's sometimes I feel that it's an emotional problem. And we just have to understand that this thing will happen. There is nothing we can do to avoid them. We just need to know that this emotional problem exists. We just need to manage. Very hard to avoid. We can only manage. All right. So this is one of the biggest reasons why people always have misconception about the bear market is because of all these very negative news. And then to top it up, they don't always put very nice caption. You realize that their face is always very, very negative. I don't know why. And by the way, I don't know why this guy always appear during a bear market. Michael Burry, if you guys know him, go and search it out. He's always a contrarian for some reason. So not helpful. So this is one of the reasons why I feel a misconception exists. And the second, so let us pause here a little bit. I think you guys are a bit distracted already. So let us play a game. Very fun one. So example, I want to give you guys a scenario. Example, every one of you are invested into 2 stocks. Okay, let us call them stock A and stock B. And after doing some analysis, you decide that, okay, sure, I'm going to invest 400,000 into stock A. Okay, and then stock B, you just put 100,000. Okay, done. Now you let these investments run for 1 year, and this is the result. In year one, after year one, stock A has plummeted $200,000. From here, we come here. Okay, and then stock B, wow, good news, increased by 100%, so $200,000. Very good. So stock A, I lost money. Stock B, I earn money. Now, question: you need $200,000 now. Which stock will you sell? So let me take out the poll. Right, guys, just at the back of your head, answer this question. I don't think it's, don't need to think for so long. Yeah, so another 20 seconds or so. All right. See the numbers coming in. Another 5 seconds. 5, 4, 3, 2, and 1. All right, so now I am going to end the poll. Hang on, guys. I'm facing some technical issues. Just give me a moment, guys. Okay, so I'm going to, I have no idea why this thing is not working. Just give me a second. All right. So okay, I managed to solve this issue, and now I'm going to share the results. So let us just take a look what is going on. A lot of you have chosen. That's good. So and then for stock A, a little bit of some of you have chosen stock A lah, so not an issue. All right. So what is going on right now? Hang on, guys. Just give me 1 minute. You guys can go and drink some water. Okay. All right, guys. So a bit of technical issue. So just pardon me. I will just try to continue from where I left off. I don't know what's going on. Okay, over here. So you need $200,000 right now. And just now the poll, we saw that a lot of people have decided that they want to sell their stock. So let me just share the results again. So a lot of people have shared stock B, and no doubt, right? I also want to sell stock B because that is what a lot of people will do. And I feel that the reason a lot of people want to sell stock B is because of this thing called loss aversion, right? So loss aversion is a cognitive bias. What it does is that when this thing happens, nobody want to feel the pain of losing money, and therefore nobody will want to sell stock A. Understand? So for those of you who have chosen stock A, maybe you understand that regardless which stock you sell, the objective is that you want to get your $200,000 back, ma. So honestly, logically, it doesn't matter which stock you sell. But because of this loss aversion bias, you want to sell stock B instead of stock A. And therefore, because of this cognitive bias, a lot of people will have this misconception about the bear market. And bear in mind, bear market is a painful thing because people are losing money here and there. So all this misconception will exist. So let us move on to the next one, which is what can we do about all these things then? Is there any tools that Shawn, you can equip me with so I can deal with the bear market? And the answer is yes, right? The first thing we can do is that we try to find consistent yielding vehicles. The first thing we can take a look at is this: fixed deposits. For fixed deposits, they are relatively safe. But then the returns are not that fantastic lah. You just have to accept that. If not, another alternative is this thing called REITs. REITs, their yield is a bit higher, but then bear in mind, you are still in the market. So there is always a trade-off. If you want later risk, the return's not that fantastic. If you want better yield, then you have to accept some risk lah. So this is some people might think that, okay, fixed deposit, Shawn, I don't like leh, because I need to lock in the money. I don't like. Is there something else or not? And then after that, some people might say, but REITs are no leh. I still think it's a bit too risky. I don't want to do REITs. Okay, sure, no problem. Point taken, all valid. So instead of doing all these kind of vehicles, why not take a look at this thing called cash solutions? So for cash solution, in case you guys don't know, there is plenty of them out there in the market, especially robo-advisors. They are providing this. Let me explain to you a little bit of the mechanics, how it works. Basically, I just pull out all these three companies because all of them, they have this cash solution, or sometimes they call it cash management. Basically, you just put whatever money inside this account, you can easily earn over here let me just take out my laser pointer, about 1.5% if you put with SAI or stash away, 1.5, and also endow us, it's 1.3%, 1.1 to 1.3%. And the risk is super, super low, almost negligible. And the best part is, unlike fixed deposit, no need to lock in your money. So anytime you also can take out. So this works somehow like an in-between. There is no risk that you need to so-called manage. And the returns are also almost the same like a fixed deposit. And the best part is there is no lock-in per se, because anytime you also can access the money. Yeah, so just to let in like a little bit on this cash solution, if you realize, if you dig deeper, you will maybe discover this thing whereby all these robo-advisors, they are also using your money to put into all these funds to help you generate all these 1.5% return. So this is the funds that Endowas is using to generate the 1.1 to 1.3% return. And then this is what SAI is giving. And this is what Stashaway is providing. And just to let in one more piece of news for you people is that, do you know you can put cash directly into all these funds? Yeah, so instead of relying on a middleman to help you generate all these returns, and then they get a cut out of it, why not be the one that directly be invested into all these funds, and then you get the full return out of it? Isn't that a better proposition? And then you realize that all these fund houses, right, they are all doing the same thing. Lion Global, SGD, enhanced liquidity. Here also enhanced liquidity. Here also enhanced liquidity. Right. So the point here is that you can also do it yourself. And just to share a little bit more, this is the historical chart of the Lion Global Enhanced Liquidity Fund. Do you realize that it's almost always on the upward trajectory? And unlike those funds that you see out there, right, where there is always a lot of volatility, up, down, up, down, up, down. Let me just take out this thing again. A lot of funds, they are always like that, like that. But Line Global, the line is almost one straight line. So to show you some numbers, right, in January 2019, the fund price was $1. And then in May 2022, which is 2 months back, the fund price was 1.05. So if you do a little bit of calculation, the annualized return is about 1.502%. It's not that bad for something where you can access anytime. The risk is almost negligible as proven from this historical chart. And you also can do it through your advisor. We have multiple platforms that we can help you put your money into these funds. Okay, so this is one of the tools that I also want to share with you about how we can better put our money into good work as well. So the last piece of advice that I want to share with you guys is that you should continue your dollar cost averaging. And if you recall, just half an hour ago, I hope you guys don't forget things because I know that a lot of people just after post-COVID, then you guys are starting to claim that you cannot remember things. So half an hour ago, I talked about dollar cost averaging. And my last piece of advice to you, very simple, is just to continue. Why? The answer is yes, it still works. So let me just explain a little bit about my position on dollar cost averaging. If the market does not fluctuate, dollar cost averaging will not exist. So you think about it. If the market is always on the upward trajectory, then what for do I need to dollar cost average? I just put my money enter from day one, then I will enjoy the entire upside. From your point of view. There's no need for me to stagger just to try to catch the volatility of the market. Think about it. Dollar cost average exists because there is volatility in the market. If there is no volatility, why do I want to DCA? Hopefully the point is taken. So for those who up to this point still don't know what is dollar cost average, let me just give you a 1-minute tutorial and hopefully you guys will understand. Over here, just for the benefit of people who don't know what is DCA. So over here, you have a over here. Let me just take out this pen. You are going to invest $10,000 every year for the next 10 years. So what is happening is that your capital will always increase by $10,000 every year, so 100,000. And then unfortunately, when you enter at year 1 is $10, but unfortunately between year 2 and year 9, the price is never above $10. It's always below $10. This is just an assumption, right? Because I need to prove that DCA works. So, and just to tie a little bit back about the units time price thing, in times of super bad period, like even year 7, the price is so depressed until $3, you can buy more units also. And this is going to pay off in the future. If you are that little bit more patient to make sure that your investment will work for you. And therefore, at the end of 10 years, because of your patience, your annualized return is 7.67%. So guys, if some of you are a bit more mathematically gifted and you want to make sure that my numbers are correct, then you can always feel free to go back to your advisor. They can also advise accordingly, just to make sure that my numbers work. So this is the last point that I want to share with you guys about how you can deal a little bit better about the bear market. And if you realize, okay, sorry, actually one more point is that this thing, in a bear market, my emotional advice to you people is that please keep calm. If ever a bear were to appear, what is the advice that you always hear? Is that you should play dead what? So if you see all these kind of news, these news, treat them as bear. Play dead and don't have a knee-jerk reaction and you will be fine. And then the bear will just walk past you in the jungle. So same thing, all these news are there to scare you. Like how you see a bear in the market and then you get scared already. Don't have a knee-jerk reaction, just play dead. Let the bear move on and you'll be fine. Okay, so at this point, if you guys realize, right, I just want to, most of the things that I say here is really just to address a little bit on the emotional side of things. And a little bit of homework after this webinar, you can go and see the investment chart of S&P 500 for the past 10, 20, 30 years. You'll realize that the chart is always generally going upwards. And then there is always some downturns that you observe. So these are the periods that are going to test people's emotion. And if you can go through that, good for you. In the long term, the market is going to reward you. All right. So this is what I generally want to share. Let me just do a time check. It's about 8:53. So I still have this little bonus that I want to share with you guys before I move on to Q&A. So maybe some of you over here want to start investment, even though it's bear market. Okay, Shawn, point taken. I want to invest. But problem is I don't have budget now. So what can we do? One easy way that I suggest you people, if you really want to invest but no budget, do this thing called relook at your major expenses. Not your minor expenses are what every day I go and buy one Starbucks Americano and then I'm going to cut that expense off so that I have money to invest. Don't do that. You will just make yourself a bit more miserable because you lose that enjoyment, but then you cannot just for doing investment. The easiest way out of this thing is just to relook at your major expenses. So what do I mean by that? The first thing you can do is that you relook at your mortgage. So guys, I know that in this environment, especially yesterday, the interest rate has just went up by another 75 basis points. I understand, but we still can do refinancing. How? So instead of looking at fixed rates, which are very high right now, consider looking at floating rates. And why do I suggest that? So let's say, for example, by the way, this slide is trying to tell you that for us, we are able to compare rates across banks. Yeah, so I just took out 5 banks to compare for you. So if you want to consider refinancing, same thing, you can go back to an advisor. We can advise refinancing accordingly also. So just to prove my point a little bit, over here, now let's say, for example, Bank A, you can refinance at 1M, 1 month SORA type plus 0.75%. And if I am not wrong, I just checked just now, I think one month SORA is about 1% or less, slightly less than that. So it's about 1.75. And then here's the good thing, your lock-in period is only 2 years. So what does that mean for you? Some people might be scared that, okay, Shawn, if I'm going to choose floating rate right now, then in the future, if the interest rate go up, how? So good news for you, your lock-in period is only 2 years. And therefore, after 2 years, the interest rate has gone up by a very big margin for floating rate. Then 2 years, you can refinance again. Just go back to fixed rate law. Yeah, nobody is going to stop you, ma. And our advisor will be happy to help you again on the second refinancing if interest rate, if floating rate were to go up very drastically and fixed rates go down. All right, so this is one of the ways you can try to relook at your major expenses. You save a huge margin on your interest expenses, and that money that you save from paying to the bank, you can use it to invest already. So this is one way. And the second way is to do this thing called portfolio restructuring. So what do I mean by that? Very simple. You can try to revisit your insurance expenses. How? In Advantage, we have assisted multiple clients to do this thing called cost reduction in their insurance expenses, but we can maintain their coverage. That means to say, whatever coverage that you have previously, we try to reduce the cost for you, but then we don't try to meddle with the integrity of your coverage. Everything stays the same, just that you don't need to pay as much. So how do we do that? Let me just give you a very simple example. This is one of my clients. She's 51 years old, a non-smoker, and these are the insurance policies that she have acquired over the past many years lah. And guess what? She's paying $28,000, close to $28,000. And the best part is this is a coverage in total. So about 1.2 million for death and TPD. Her CI coverage is about 700,000, and she's paying about $28,000. So bear that in mind. So now, our objective is what? We want to reduce cost for this lady. So before, it's about 28,000 again. Let me just re-emphasize. Her coverage is as such. Now, we do this thing called comparison. And then I took out these 4 companies for my client to consider. And of course, I think any normal person will just go for company S, because I mean, that's the most affordable, right? That's the most competitive. I don't think anyone will choose company NI, right? I also won't choose. And then after that, not only have I saved so much money for this person, for this lady, her coverage have also been boosted to 2 million across the board instead of maximum 1.2 million only. So the cost savings for this lady per year is now $18,000. That means to say she has $18,000 to invest right now, like every year. Think about it. So, but of course, just to put another disclaimer out here, is that not everyone can do insurance restructuring. It's really on a case-by-case basis. And why do I say that? Is because insurance, there is this thing called medical underwriting. So if your health, there is some problem, there is some medical history already, then sorry to say, maybe this thing might not be suitable for you. In fact, we don't encourage trying to restructure your portfolio, because that means to say, if we want to do this, it's a fresh application. We have to re-underwrite. And if the terms are not that good, then we are actually putting your portfolio in jeopardy. So not for everyone, but if your health is still in good condition, you can always go back to your advisor and then see what we can do for you. So this is the second point I want to share on how you can try to relook at your major expenses to find money to invest. And the last point is, instead of also looking at your major expenses, I also want to touch on this later topic called repurpose your asset. So just now I say refinancing, restructuring, and now is repurposing. So how do we do that? Very simple. Let us take a look at this typical income statement of most Singaporeans. in Singapore, we have this thing called, most people have this thing called expenses, and most people also got income. Okay, right? Straightforward, right? Nothing rocket science, no rocket science. So most people have this thing called either mortgage or rental expenses they have to pay every month, and also insurance expenses, utilities, bills, food, and transport. Right? Then there are many other expenses, but I just put the more common one because I just want to prove a point. So let us take a look at income to see what's going on. So income, everyone has this thing called salary. And then after that, everyone also has this thing called salary, 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 salary. So, ladies and gentlemen, do you find something very funny over here? Everyone, the expenses are so diversified, but why is nobody diversifying this part of the equation? May I say that if one day, either your health takes an impact and you need to rest, you cannot work anymore, you wipe out all 6 of this plus sign, and then you have problem servicing this part. So this is number 1. Number 2, in the event of a bad economic situation, maybe even worse than today, this part will also be gone. And I kid you not, even your insurance, all this will not be able to help you. So can we do something about this part or not? So let us take a look what we can do. What if I can find more income sources for you? So firstly, one income source you can thought of, and it really all ties back to just now what I said earlier, right? So the first thing you can do is, instead of relying some part of your salary, I take away one plus sign, and then I replace with this thing, dividend income. Now, you rely a little bit less on your time exchange salary, your time exchange income. This dividend income, you do not need to exchange time for it. You just sit at home, shake leg, the money will come. So this is number 1. Number 2, one more arrow gone, or one more plus sign gone, and we can consider this thing called annuities. So what is annuity? Very simple. It's an income product. It's an income paying product by insurance company. What it does is that it provides a very stable amount of income every month, albeit the return is slightly lower or sometimes very lower than dividend incomes from capital or debt market instruments. But the good thing is that the income is very stable, predictable, and sustainable also. And same thing, you don't need to work for the money. You don't need to exchange your time for the money. It comes to you every month. So this is number 2. And number 3, if some of you love property, you like the idea of having property under your assets, and you like to maintain assets, no problem. I also like property. You can rent, you can just buy and rent out for rental income. So now we see that our income source is way more diversified. Instead of relying on salary, now you rely a lot less on your salary. Even if there is a bad economic situation, your salary is not a problem. If you lose your salary, all these income sources will be able to take care of this for you for a short term. And the best part is, because just now I told you to relook at your major expenses, to find more budget to invest. Now you have opened up more salary spaces. Just now there were 3 plus signs over here, all these 3 plus signs are also additional money for you to go and invest, because all this part can take care of the rest of the expenses for you. So this is the extra part, bonus, that I want to share with you guys. How sometimes we also try to recommend to people the way we do things. And yep, I have almost come towards the end of the webinar. So before I go, there are 2 things I want to share first. The first thing is, I want to ask you guys, is your entire investment portfolio very capital gains focused? So if it is, maybe consider switching some to a bit more income focus, so that, just like my previous point, you do not need to worry when a bad economic situation hit and then your salary takes a hit as well, because the income there is there to protect you from a bad economic situation. And my final parting words to you guys, ladies and gentlemen, before I end off the Q&A, is that if the end goal of financial planning is not to be free from time-based income, then what is? Okay, so I have come towards the end of the webinar. I will stay around for a short while to answer some Q&A before I end this webinar proper. And so for you folks, if you want to inquire on this thing called, just now I mentioned earlier, asset repurposing, mortgage refinancing, and restructuring, you can scan this QR code and then our advisor will come back to you very shortly. All right, thank you guys. I have officially finished this webinar, so I will just stay back a little bit to answer some Q&A. And for those of you who are feeling a bit tired already, thank you. You can go and rest already. All right.